Whitfield, brought to you by Satrix. Own the market.
Welcome to the Money Show. It is 27 minutes to 8. We've got questions from the floor. We'll take those in just a second. We're doing an outside broadcast from Prime Media Place in Sandton in Johannesburg. And on stage with me this evening got Helena Conradi, the Chief Executive of Satrix, Candace Payne, Strategist at Satrix, and Simon Brown, the financial educator at Just One Lap. Now, Simon Brown's idea of a fund stock to pick is an exchange-traded fund. And people just say, oh, what's the hottest thing on the market? And you go, I don't know, Joburg's temperature outside the JSE, the street. If you lie down there, you'll get burned. That's a good place to get burned. Now, I asked Candace Payne just before Eyewitness News at 7:30, I said, is there ever a way in the world where you should have just exchange-traded funds? And you said no. I would have thought as somebody who is a disciple of the exchange-traded fund, as a market-performing, low-cost investment, that it is the way, the truth, and the light.
It's absolutely not. So investing is not one size fits all. Each investor has different needs. They have different time frames, and you'll hear me speak a lot about time frames. They have different risk profiles. ETFs are high-risk investments. They invest in the stock market, and if you're going to invest in the stock market, you need time. If you don't have time and you're scared of volatility, you need to be keeping your money in the bank. There are also very many ways to skin a cat in investing, and I know that we spend a lot of time obfuscating and keeping you lot in the dark with jargon, but all you're after is a performance that matches a goal that you have. And if the ETF is something that is going to, with a high probability, do that for you, then by all means, let's look at the ETFs. Let's look at all the underlying asset classes, the offshore, the local, the smart betas, which we haven't even touched on. But if that's not your need, and it's really not going to reach your goal, then you need to be looking at some other type of investment vehicle or some other type of asset allocation. So I think ETFs are great. They serve a purpose, but they're not for everybody.
Simon Brown, I mean, that's a quite contentious statement for somebody whose livelihood depends on exchange-traded funds. But the reality is you are buying shares. Ultimately, you are buying those hot stocks and some that, frankly, are not. And not everything goes up in a straight line.
I agree to a fair degree.
But tell me the part you disagree with, which is much more interesting.
I can get a money market ETF. I can get a bond ETF. I can get a listed property ETF as well, which are certainly a bunch of the asset classes. And I think if you're in the ETF world, then you really want to be cognizant of what the ETF is and what the fees are and the like. If you're stepping out of the ETF world, I mean, there be shocks, in terms of what are fees, what are performance and the like. And for a lot of self-managed portfolios, I say to folks, if you've got a Candace Payne that you can go and chat to, or some of the experts, and they're an honest person who will give you an honest deal for an honest price, sure. But if you're doing it yourself, this desire, people come into the market and they typically start at the wrong end. They start with derivatives and lose their money, and then they start with penny stocks and lose their money. And if they would just start with ETFs,
the most common question, and Bitcoin has taken over in terms of the most common question I'm asked. It's not an investment. And the other one I was asked about mostly last year was binary options, because the world is full of sharks selling products via Facebook and via social media and getting into people's inboxes that way and saying, look at this guy, he drives a fast car now, and 6 months ago he was washing windscreens at Greyston and Fredman Drive. And it's that sort of alluring nonsense that gets people burned and gives investing generally a bad name.
And there's only one way we get rich in a hurry, and that's if we marry money. Aside from marrying money, wealth creation is a process. And if we come into the market and say, we accept that this is going to take us decades, not even years, it's going to take decades, and we're cognizant of that fact, and we're accepting of it, we can do this. It really is as easy as falling off a bicycle.
But
not as much.
It can hurt a lot more than falling off a bicycle. We have a question in the dark recesses of the room. Who is that? What is your name and what is your question?
Hi, my name is Mas Chava, and basically, I don't know, the biggest problem we have, so I'm part of Investment Club, and that's why I'm here today.
Well done.
Thank you. And the biggest question we have is deciding on what ETF to purchase. So if we have an instance, as we currently do at the moment, where we have the core shares S&P 500 versus the Satrix S&P 500, and today the core shares one is performing better than the Satrix one. However, they are tracking the same index. So my question is, what would cause that discrepancy between the performance of the two different ETFs? And second to that, discussing amongst ourselves, we thought it's probably because of the weighting difference between the constituents that you guys allocate.
Don't answer your own question, Masachaba.
No, but there's a follow-up, right? Because if this is the answer, I need a follow-up. And if it is about the weighting, how do you then decide the weighting? Because as you said, you don't have the guys driving fancy cars and wearing tailored suits doing the decisions
No,
for you.
that's the finance minister. He's also got a very nice watch. Masachaba, thank you very much. It's a very good question. So how does one index tracking fund that is supposedly doing the same job as another underperforming one and the other?
Okay, so if you refer to the S&P 500, then there's another party that is actually introduced to this whole process of investing in the ETF. S&P is an index provider. We track their index. So neither core shares, neither Satrix determine the weights. It's actually S&P. So we track exactly the same index, and the performance should be exactly the same. The fees might differ, and the pricing might be done at different times of the day. But over time, you should see the same performance because it's exactly the same. The weights, they don't differ at all.
Simon?
Bruce, if I can jump in, there's also, if you're looking, so ETFs have what I call a dirty close. And what I mean by that is that there's not, the market closes at 5 o'clock, we have a closing auction and we get a closing price. So Richmond closed at whatever, and tomorrow we've got a percentage move. The ETFs don't trade in that closing auction. They don't trade at 5 o'clock. So therefore, the JSE does a mathematical process to get a price, and therefore the two ETFs will potentially have a different technical closing price. So it's more a case of, rather than looking at it on a single day, you've got to stand back and look at it over a period of time, and that time should be months or years. And just to throw a final spanner in the works, Signia listed an S&P 500 fund this week as well, so now there are 3.
But I mean, as an objective voice on this panel, other than price, is there any difference?
No. So you've got perhaps the one difference. Some
and
of them,
service and smiles and loveliness. I mean,
sure, and do they give you chocolates? I mean, so you might no chocolates. Some might be total return, and that's, in other words, the dividends are automatically reinvested for you, and that may or may not be an issue for you. You might like it, you might not. Assuming they're completely vanilla and they're both exactly the same, it is, what is the total expense ratio? What is the price that you pay? Because in essence, you're getting the same 500 stocks. You're getting Apple at 6.4, and you're getting Google and Facebook and all the rest. And then the question is, how much does it cost me? And the beauty is that we're talking about fractions of a percent. The difference in price is 0.1, 0.2. I can remember the days when difference in price was 2 or 3%. Don't get me wrong, 0.1, 0.2 is different. You can have a different vintage wine in retirement. But it just comes down to price these days.
Okay, great. Another question from the floor. Where is the question? There's the question. Hello.
Hey, how are you? Thank you, Bruce. My name is Aubrey. And what I want to ask is that upon learning about this event, I went onto the Satrix website and I looked at some of the products you guys offer. And yes, I think, exchange traded funds is very attractive, but they seem rather conservative. The highest rate that I could see there was about 13%. I know balanced funds, good ones, you could get 15%. And I know like full-on equity portfolios, you could get about 19, 20%. So I don't know. I would just like you guys to educate me. Are they really conservative, or, is my perception wrong?
Good question. Thank you very much. They track what the market does, or a particular segment of what the market does. So if you've been invested in the Satrix Resi, for example, I hope you got the number off the top of your head. I mean, over the last year, the all-share index has given you 17% from 12 months ago. The Resi's probably outperformed that, hasn't it? Because resources shares have had a very good year so far. What is the number on the resources index?
I don't know what the number is, Bruce.
Simon.
I'll throw you one number. 2006, the Satrix 40 went up 42%, because that's what the market went up.
And some unit trusts would have done better, but not many. And that's
not many.
And just give me the facts here, because Aubrey needs to know on the broad global averages, and if you've got local numbers, that'd be good. What percentage of managed funds, in other words, somebody with a nice car and the flashy suit and the yacht, what percentage of those guys over a period of time outperform the index?
So S&P Global, who do the research, they do it locally, they do it around the world, they do it for 1 year, 3, 5, and 7 year. On average, maybe 10 to 15% of active fund managers beat the market. So that's about 1 in 5, 1 in 6 beat the market. And that then becomes, the question around how do you choose an S&P 500 ETF is simple. What's the expense ratio? Which of these many, many asset managers are going to be the one beating the market? And it's not as simple as buy the one that beat the market last year, because often that doesn't work. So that becomes massively complex. And the truth is that this is an industry where 80 to 85% of the experts are actually not doing what they say they would do on the sticker. And I mean, if they were surgeons, they would all be out of business. Just saying.
The patients would have died.
Exactly.
Aubrey, I think your question, though, leads us to the point of tonight. And that is, you told us that index funds are dangerous. They're scary things. They are exposed to investment markets. And investment markets go up and they go down, and not always in that order. And Aubrey looks at this and says, well, the returns are conservative. Well, the return is what the market gives you. But as you said just before Eyewitness News, Candice, you shouldn't be using index funds in isolation. You mentioned something called beta blocker, beta plus, beta alpha,
Smart
beta,
beta.
gamma. Smart beta, I knew you did something like that. You've got to, if you want to outperform the market, well, then it gets a bit more scientific, right?
Absolutely. So if you're tracking the market, you're going to get what the market gives you. So if the market gives you 5%, it gives you 30 or minus 5, that's what you're going to get. Smart beta ETFs are tracking an index that is different to the market index. That's basically what smart beta is. So beta is the volatility of the market, and we call it 1. If your portfolio has a beta of higher than 1, you're more volatile than the market. Lower than 1, you're less volatile. And smart beta implies that you have a different constituents of the market to try and outperform the market. So let me give you a very simple example. You have the Satrix Top 40, which is the 40 largest companies, which we've spoken about. If you do just simply have an equally weighted top 40, so instead of having Naspers as the biggest stock in your portfolio, you mute the performance of Naspers, which you wouldn't have wanted to do.
No, you wouldn't have wanted to, no, not yet.
But you mute it because you bring that weighting down to 2.5%, because you've got 40 stocks now that are 2.5%. You have changed the beta of the market. So you are no longer tracking the S&P, the Satrix 40, but you have the same 40 stocks in different weightings, so you're going to get a different performance. And you may have the view that that is a better thing to do. So Naspers has given you 53% this year.
52 and a half. It was down a bit today.
Between friends. Which is fantastic, and if you'd held Naspers, you're happy. But if Naspers had given you minus 53% and you were holding the Satrix 40, you wouldn't be very happy. But if you were holding the equally weighted top 40, you would have minimized that minus 53 in your portfolio. So it really is about cutting up the index in a different way to get a different outcome. And that's when you need to start understanding what's in your ETF. And that's when you can start outperforming the market, as we call it.
Simon Brown, I want to come back to you for an Aubrey, for example, who might want to have a little bit more oomph. He's got a flashy shirt. He wants the sort of performance that his shirt is delivering this evening, and he's got a very nice, bright checked shirt. It's a standout shirt in this audience. And if he wants to do the market equivalent of his shirt, how would he do that? Using exchange-traded funds with a little bit of zing on the side as well. In a moment, Simon Brown.
Today. Investing with Bruce Whitfield. Brought to you by Satrix. Own the market.
It's got nothing to do with me. It's got everything to do with Helena Conradi, Candice Payne, and Simon Brown, who are our guests this evening, with a lovely studio audience. Now, Aubrey was complaining and saying that index funds are just dull and they're a bit conservative. Now, if Aubrey's wanted to get a little bit of beta into his life and take a bit more risk than the index provides, he might have a portfolio of, 5, 6, 10 shares. What might he do?
Absolutely, Bruce. So the first step that Aubrey can do is actually go and buy some more sort of exotic ETFs locally. We've got an emerging market ETF. We've got a BRICS, so that's an ETN. Let's park that aside. We've got an Africa ETF and the like. So we can start getting some a little bit more exciting there. But the way I structure a portfolio, and the way I typically say to folks, if you want to sort of actively be involved in this, is put ETFs in the core. So you've got a core of ETFs, which to my mind should be a minimum of 50%. going upwards, so somewhere between 50 and 100% of ETFs. And then around that, you select yourself some absolutely excellent quality shares that you think over the long term are going to give market-beating performance. And you go in essence, you create your own smart beta sort of portfolio. The word of caution I give to folks is start the other way around. In other words, start with 100% ETFs and slowly work
but
down.
that's a sensible approach because
I know.
you're learning about the market, you're
Yeah, I
learning
know.
about volatility, you're learning about your own risk appetite, and you're learning as to just how much risk you're actually willing to take.
Because risk is lovely until it goes the other way. You know,
It
I mean,
is.
NASPAS is the best thing in the world until it's not.
Well, don't you wish you'd sold every ETF and every other investment that you had 10 years ago and just bought an USPAT share?
A Bitcoin.
And,
Okay, a NASPAS share. Yes.
Bitcoin, that would be good.
But that's exactly it. So you start with 100% ETFs, and then you go and you find a couple of, quality stocks. And maybe you want to get really, really aggressive, and you go into the mid-cap space and you buy yourself a mid-cap. But understand, as an active investor, that part there, your biggest risk is not CEOs or auditors or results or politicians or anything. It's you. It's making bad decisions. It's not exiting. It's getting, too. I own a share.
I'm not pointing fingers.
No, we're not pointing fingers.
We're not saying greedy.
But and you buy the share, and I'm looking at a share today that I thought was a great stock, and I've owned it for a year and a half, and it's made me exactly just under 1%, and that's my fault.
I'm trying to think which one it is.
Tonguat.
Tonguat.
Turned out the rain came, but it didn't help.
No, it didn't. Right, questions. Tigiso, where are we? We are at the front of the room. Your name, please, and a quick question.
Hi, I'm Kavir. My question is directed to Simon. Simon, I'd like to know, with aspects such as political uncertainty affecting our economy, what percentage split should we invest? What do you recommend to invest between global ETFs versus local ETFs?
Good question, Kavir. Thank you.
Oh, hard question. So, very hard question. I'm going to come to your answer in a long way around, but I'll keep it short. The first point is that if you look at the top 40, which we've been talking about as a vanilla ETF tracking our market, is that probably somewhere between, it's probably 2/3 or 3/4 of the profit of those companies comes from beyond our borders. It's NASPAS, which is, it's DSTV, but it's mostly Tencent. It's Richemont. None of us can afford a Richemont watch. Those are the people in China and Europe and the like. And a bunch more of those stocks which are earning their money beyond our borders. So our local market is a lot more globalized than a lot of people actually realize. And in that sense, if we move into a mid-cap space, then we're a lot more SA Inc. Exposed. My typical response is that your split should 60-40, there's one way or the other. My current personal split is about 60% local, about 40% offshore. But if we then take that weighting within the local, it's probably actually closer to a lot more offshore. And I try to do the math in my head. But
No, but you've probably got about a 70% offshore exposure, courtesy of the fact that in your ETFs you've got the Richemonts and the Naspers and the like. I hope that answers the question. Final question from the floor, again from the dark corner. There we go. Quickly, with a minute to go, and our set's falling apart, but that's okay. Quick question.
Hi, my name is Lebo Tawajani, and I'm an interior designer, so finances are not my strong suit. I'm a creative, so I just wanted to know, in approaching ETFs, EFTs. ETFs
are the ones where money go out. ETFs are where money comes in.
What would be the best approach? Is it more of a lump sum or monthly, kind of like a debit order, or is it better to, do whenever you can? And also another question would just be like, would it kind of replace an RA? Is it
Lovely questions. Well, thank you very much. Candice was shouting at me earlier for not having a debit order. So debit order is a good way to go. And also trickle into the market. Don't flood the market. Flood your money into the market. You've got 10,000 Rand. Do $1,000 a month or $2,000 a month.
Absolutely. So I mentioned the time word earlier, and investing is all about time. Debit order is also your friend. So it's something that you can set up. It just happens in the background. You're not watching it. We think we're disciplined people, but we're not. So that is one way of growing your wealth specifically. If you have lump sums and the markets are at all-time lows like 2008, that's the time to pile in. but we're not in that situation at the moment. So really for investors who are starting out, set up a debit order, put it into the Satrix 40, do not put all your wealth into one ETF, and just watch how it goes, just learn, just get comfortable with the market volatility.
Okay, that is good guidance. And the other part of the question, because Simon Brown, you were listening very closely, was?
Retirement annuities.
Is it better than a retirement annuity? Should you bail on the retirement annuity? Retirement annuity is kind of different because that's before tax money.
Yeah, so my advice is no. My advice is you do both. The benefit of retirement annuity is tax implications. Be careful of the fees, and it's different at retirement. So I think they're not mutually exclusive. I think you can do both.
Simon Brown, thank you very much. A financial educator at Just One Lap. Helena Conradi, Chief Executive of Satrix. And Candace Payne, the strategist and consultant at Satrix. And a lovely studio audience here at our Prime Media Place head office in Sandton. Thank you very much for coming. Thank you very much for listening.